All right. Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for August 25th, 2025. This is a special episode, actually, because today is the 11th anniversary of the start of this series. So, 11 years ago today was the first episode of this. And of course, you can still review any Timing Research episode or event on TimingResearch.com. The full 11-year history is there to review at any time. So we are recording this today at 4 p.m. Eastern Time, and this is episode number 491. So my name is David Kosmeter. I'm the creator of TimingResearch.com, and today the panel that I have invited to join us is Dan Passarelli and Dean Jenkins was supposed to be here. Hopefully, he'll be able to join us in a minute. And Erik Gebhard, also the option professor, is here to moderate. And then, if you're in the room live, be sure to stay afterwards. Jim, the option professor, is going to do a short market analysis segment after the show. Or if you're watching the recording, the recording of that will be in the same place wherever you found this one. So I'm going to go ahead and turn it over to the option professor.
Okay, thanks, David, and good to be with you guys. We got a lot to talk about because we had a big change of mood a little bit at the end of last week after the Powell announcement in Jackson Hole. But today, of course, looks like a little buyer's remorse from the standpoint of the prices haven't really followed through on the upside. So before we get started, as we get started here, let's get an opinion from you guys on what you think's happening right now, and what in the shorter term, what do you think we might see? So I'm going to start out with Dan. And Dan, what do you see on this S&P here? It looks like it's testing this high area, and what do you think is going to happen?
Well, I think it's going to fail the test, Professor.
Okay, yeah, have to do a little summer school. Going to get a little summer school on these guys. Yeah.
Might have to. Might have some Catholic nun action going on.
I would know what they look like. St. Luke's Grammar School, Don Bosco High School, and Boston College. That's about all the Catholicism I could handle for one lifetime.
Holy cow! How your knuckles look.
Yeah, exactly. Oh
Uh,
God.
yeah, I mean, if you look at the market just from a pure valuation standpoint, I mean, everybody knows it's overpriced. I mean, just the PE ratio is just way, way, way too high. I mean, it's extended. You look at the RSI, we've got, going from a technical standpoint, we've got a divergence going on, which we have in the on balance volume also. I expect to pull back.
Mhm.
Could be wrong, but that's what I expect.
Well, that RSI underneath looks like a pretty good divergence, right? Staring us in the face. You know what I mean? You can see we had a high. We had a high point in late July. Then we had another high point, but the RSI never took out the old one. Then we just had another test to here, and it looks like the RSI is in a pretty good. That's a nice sized divergence in those RSI numbers. What do you see there, Eric? Do you see anything that tells you anything there with that divergence on the RSI?
Yeah, well, I think that's kind of one of the things, the few technical indicators that we kind of really pay much attention to. It would be not just the absolute level of the RSI, but of course that can be important, but the divergence. So yeah, you have got those sequence of three higher highs on the S&P, and the RSI is actually declining in both time, all three times. So yeah, I think as Dan suggested, there's a opportunity for buyers to perhaps get better pricing on a pullback, but it is the end of the month here this week, so you
Oh
you
yeah.
get some of those flows coming in with all the month end markups,
Mm-hmm.
and in spite of valuation and fundamentals and whatever else you want to throw at it, sometimes the flows just call the shots. But another 1% pullback would be probably a good buying opportunity in my assessment, unless a lot of those internal market mechanisms and dynamics and flows, dramatically shift. I mean, the VIX has been declining. You've got what do we one rate cut in September. Is that the projection right now?
Well, they are counting on that. That's for sure. Of
Yeah.
course, we'll have to see what these jobs reports and the other. But I mean, who knows what we can trust anymore? Because it sounds like they're going to force people to give them the numbers they want or get fired.
Yeah, I mean,
That's kind of scary, right?
those,
Because they're going to control CPI and they're going to control the jobs numbers, which are kind of big numbers to be controlling.
yeah, I just wonder, it seems like in the last couple of years in particular, you get what seems to me a lot of numbers that perhaps leak the day before, and you get these moves, and the numbers come out, whatever they are, the print is whatever that headline is, and then of course the market doesn't either believe it or care because it's already moved, and then it gets adjusted dramatically anyway. So I mean, it's like I don't know, it's a banana republic in that sense, in my opinion.
Yeah.
But what do I know?
I guess they do serve. I don't know. I never looked at how they made the sausage, but I guess the way they make the sausages is do surveys, and if
And nobody's
people,
responding.
yeah, or nobody's responding, or they keep changing the response. So, but I don't know. You had to shoot the messenger. You probably should have shot the structure of how you get the numbers or something. Somebody said it would be better to just gauge how many people are hanging around Starbucks, because that would tell you how many people should be at work or something like that.
Yeah.
But also on the CPI, they wanted to go with where you take out housing so that you could. It's kind of like the S&P. The S&P is not the same index it was 40 years ago. So to talk about the S&P index and use it as a comparison is kind of rough too, because the stocks that were in the index in 1975 are not the same ones now. That's for darn sure. So
yeah, absolutely, kind of apples to oranges in some regards, and S&P seems to add companies when they're at their all-time highs and sell them when they're at their lows as well. But
yeah.
Anyway.
Yeah. Well, let's talk about something else that's kind of a big thing, I think, because you guys both do options. What do you think of this VIX? It is just constantly shrinking. It picked up a little bit today. Friday went home at like 1422. I mean, do you see this VIX going much lower, or is the VIX kind of telling us that some kind of a correction might be coming because of the way I saw it? It went down to like 14 and change, had a rally and gapped up, and then it just filled the gap. And then basically now it looks like it's going back up. So do you think well, Dan, how are you reading the VIX, and how are you using the VIX to try to figure out what to do with your strategies?
Yeah, I mean, there's always like a philosophical discussion of, is VIX the tail or the dog? And, I think it's clearly the tail. Right now, VIX is priced over historical volatility, which implies that options are overpriced. But what drives the market ultimately is always fundamentals, and and technicals, but especially fundamentals in the long run. And so if and when the market does have a pullback, that relationship just changes. Even if implied volatility is overpriced now relative to how the market has been moving, if and when it moves differently, that all changes. So, I'm not super excited about putting on a whole lot of option or premium selling trades. I do put them on. I put on covered calls in particular, and some very strategic cash secured puts. But I'm not slinging a whole bunch of credit spreads and iron condors and such in this environment, even if from a volatility standpoint, they look like they'd be beneficial.
Right. Like, so do you think this VIX, as long as it's under, like that 17 number and 19 numbers, we're probably going to stay in the bull trend?
Yeah, but what I really think about it, what I really like about it, how I'm really trading it, is looking at it as it's it's a good opportunity to look for hedging opportunities, just because you can pick up your hedges for pretty cheap.
Yeah. Yeah, no, they are cheap. Insurance is definitely on sale. There's no doubt about it. Is the VIX affecting what you're doing at all, Eric?
Yeah, yeah, absolutely. And I mean, it's been good to us. I guess well, which is to say, I guess we've been fortunate to be positioned okay recently, and then, you know, did well Friday and so forth. But, when I say we did well, we're not managing money, but, some of the recommendations that we might have for our clients, that's what I'm referring to. So, I think the VIX in this level, I completely agree with Dan in the sense that, when's the best time to buy insurance, so to speak, is when it's cheap. Um, on the other hand, you get sort of this level here in the VIX, and I think it could drop further, maybe into the mid 13s, but below 19 or so, that's kind of a sweet spot for some of the things we like to do. Um, in terms of collecting premium, I know Dan suggested it's a little hesitant to collect premium right now, and I guess it's fair to say, we should always be hesitant to place any trade to some degree, but
Yeah,
there's
yeah, yeah.
always a hole in every strategy, no matter what. But
Mhm.
you know, um, it is, I guess, sort of in the investable space right now. Whether you want to be long stocks, and if the VIX were to spike and gets into, let's say, above 30 or something, yeah, you can get juicy premium by collecting premium, but you know, you're also, kind of stepping in front of a much higher level of volatility at that point too, and higher odds of getting run over. So we're comfortable with doing some of the things we do with the VIX in this range, maybe 13 and a half up to 19. I still think there's opportunity to collect premium on the S&P, or in particular the E-mini. That's what we trade. So that's kind of our thought process, at least.
Yeah. People do forget, and Dan was bringing up a good point that ultimately is the fundamentals. They have no idea why the index goes to certain levels. Like on the S&P, the earnings for this year is around 275. If you times that by 23, you're at 6,300. If you times it by 22, you're at more like where we are now, 6,100. So you can see why we're in this neighborhood, because the earnings times 23 equals that number. I mean, people. So if the earnings go to 300 and we go to 23 times, you're going to be at 6,900 on the S&P, and there'll be a good reason for it, because earnings in Q2, I guess, we're up about 12%. So, um, the earnings are continuing to come in a little higher than people expect, right?
Yeah, yeah. I mean, they have been, and I mean, honestly, they typically do come in higher to varying degrees, and they've been higher than even expected, which also they tend to do. But so yeah, I mean, that's the thing. You can't fight the tape, and I mean, Eric was mentioning that they still like a lot of premium selling strategies, and when it's working, you just keep making it work until it works until it doesn't work, I guess they say, right? So,
Yeah.
while
Yep.
I say I'm hesitant, I mean, I'm not completely morally opposed to any option selling, because I am doing that, but just picking my spots.
Yeah. Eric, when you're looking at trying to create parameters, which I think you do sometimes with the credit spreads, uh, do you use like the former lows? Like we've had a pretty significant low on the E-mini at around 6,200, and then we just had one at around 6,350, the ballpark areas.
Right.
Would those be levels that you would kind of use, or you even, because the premiums seem to be pretty healthy all around, do you even go wider than that? Um,
It depends on the days till expiration,
okay,
the length of the spread in
the
terms
time
of
risk, yeah.
time.
Hmm.
Yeah, but like for example, today we had some people doing on the E-mini S&P 500 on the October end of month contract. So that has 68 days till expiration. Selling like 7,000 calls, That's the strike price, not
Mm-hmm.
the number, the quantity.
Kind of big hitter
And
you're dealing with over there.
yeah. And the I think 58.25 or 58.20 puts, as I recall, on the downside, and then buying some protection. And we have some of the standard condor strategies as well, and we do something we call a dragonfly that adds another leg closer to the money, another long position closer to the money for an additional bit of insurance. So takes a little bit of the profit off, well, it reduces your profit potential, but it
Yep.
also makes the trade a little more robust. And you can also close out those positions often much earlier than a standard condor. We'll always plan to exit before expiration. We don't hold things till expiration. So trade might say it has 60 or 70 days till expiration. You're more than likely, if it goes well, you're going to be out, within 30 or 40 days probably.
Yeah, because the time premium will come out if the thing doesn't get challenged.
Yeah, if it doesn't get threatened, it can then reach maturity. But again, that's it doesn't always go perfectly, as we know.
No, but the hedges seem to have been it's a pretty effective way to make sure that the person holding the position, doesn't get so jittery every time it jerks around a little bit, right?
Yeah, that's exactly one. I mean, that's kind of really the whole theme behind it, which is a typical retail investor often, loses sort of, I don't know, they tend to spend a lot of time focused on where they're going to get into something. And then once they're into a position, they're not really, once the battle starts, right, and the bullets start flying,
Mm-hmm.
they're not always exactly sure what to do and how to handle it. So, having the additional hedges in place makes those trades, I guess you could say, more robust is the way I like to look at it. And, we have some signaling, some algos we've kind of created behind the scenes that kind of give people an idea of when they can close the trade out if there's too much risk, or when they can take profit as well. So try to take some of the emotion and guesswork out of it. That's how we think. That's how we think about it in terms of over the years. We think, well, based on all the feedback from clients, at least, that's kind of the common theme, which is, I wish I could figure out how to manage my position better, whether it's for a profit or loss.
Yeah, I was wondering, Dan, when you do the credit spreads on an exit strategy, there's a lot of different opinions on how to manage it. But let's say you did an out of the money put or call credit spread. Do you tend to, because you have the insurance anyway, and your maximum exposure is, do you tend to let it go to strike? Or I know years ago we used to say, let it go into the money a little bit. And then do you immediately roll it? Or do you say, I'm getting whacked on this side, I'm going to go to the sideline, and then I'll come in and consider rolling it after I see exactly how big the locomotive is here?
What I usually do is I do let it go all the way to the strike.
Mm-hmm.
And I usually wait until, well, I mean, it depends how much time there is to expiration, but
Yeah.
I usually let it go another day for a confirmation and then close it, which, I mean, it can be a long leash for sure. But that's what I tend to do when it's going against me, just because, you could get that turnaround every now and then too.
Yeah, yeah. And also, like I say, as long as they're out of the money and as long as time's going by, the requisite necessities are going on,
Yeah,
because
yeah.
people on the buy side, they have a hard time understanding the concept of that the options will be going to zero if they're out of the money.
Yeah, yeah.
Yeah. Like I say, and but on the sell side, you can't give it too much rope because you're on a limited gain situation. So obviously you have to be careful that you're not giving it so much rope that you could have cut it off much earlier once it started to look like rain, or when it was starting to rain a little bit, as opposed to waiting for the flood. You know what I mean?
Yeah, I do. And so, I mean, I will wrap into it, some indicators now and then, but I don't know. I just like to use that strike as just a very solid, it's beyond the strike.
It's a
That's that.
discipline. Yeah, it's a discipline. Yeah, it's a line in the sand, and you got to respect it. Are you generally leaning towards indexes because you do something like put writing on Viking Therapeutics, and they open down $40? That's a rough racket.
Yes, indeed. Um, yeah, I mean, as far as put writing goes, I do that on my SPY position on a regular basis. But I mean, I do have some stocks also that I'm always in the wheel on, covered call or cash cured put, namely ones like Apple and Amazon, which are very, very liquid names.
They are, yeah.
But, I mean, I'll even do them sometimes on less liquid names where if I can get in just at a decent price, because it's a covered call or cash secured put, and if I'm doing it on an illiquid name, I actually kind of want the assignment. I'll just let them go all the way to expiration,
Yeah,
you
yeah.
know, which I
And
wouldn't
some,
do.
yeah, some stocks, like I was looking at BMNR, and when it was down at around $30, I was kind of a big believer in it because I've been sold by Tom Lee and his diatribes on how this um, this Ethereum is going to be the backbone of stablecoins. So I
Mm,
kind of bought into the thing. You see, when it went down there to like 30, right? And
mhm.
so you could sell, and I talked to some people about it, where you could sell a $20 call and then buy yourself a call spread going out like a little bit further in time. And you could actually have, somebody else pay for your call spread. And, but you have to be willing to buy the stock at 20 or 25. And if you believe in the story that they've been telling, and apparently Stan Druckenmiller and Peter Thiel and Kathy Woods and Bill Miller believe in it because they're investors in the whole thing. I thought that was a pretty good strategy. Sell the put, agree to buy the stock at 20, $25, take the premium, buy yourself a call spread out there, a year out or 9 months out, and see if this thing is real or not. Because if it's real, obviously it's probably going to go up way higher than $70 or $80, right?
Yeah, I love those kind of just more strategic things where you're able
Yeah.
to pay for it. I mean, the big trick there is really like knowing in your soul that you do want to buy it at 20
Yeah,
and
and
not,
that there's a floor that you believe that is a floor as well,
yeah,
because obviously if the stock goes down to $5, and if this story is a bologna sandwich,
yeah.
that is the risk. But so far it seems like it's not a bologna sandwich. But like anything else, if it is, you're going to lose some money. But like a stock like Apple, at $200, that wouldn't have been a bad time to play this game either.
Yeah. Yeah, yeah, for sure.
So you're right. You're right. You need to have a stock where you really believe in the floor that you're creating. And if you think the floor is made out of balsa wood, you don't do it, you know, that kind of thing.
Yeah.
Eric, when you're again looking at the credit spreads, are you mostly using the indexes because of liquidity and the tight spreads?
Yes, you nailed it. So that's our focus on the E-minis, primarily the E-mini S&P 500, and then subsequent to that, we will do the NASDAQ 100 and the Russell 2000. So those are the symbols we focus on, but of course, we can trade anything.
Mm-hmm. Let's discuss that Russell you brought up because I've been a real big proponent of it. I thought the floor was at 200, then I thought the floor was at 215, and I think it wants to make a run for that 245. But I think as long as it stays above 215 and 223, maybe it'll finally get going because it isn't even at the highs of 2021 or 2023 or whatever 2024. Are you kind of keen on it, or do you think this is another thing that's going to disintegrate just like it's done every time it goes up?
Well, Friday, I think coming into Friday, I had read that it was the most net short or the most bearish consensus, I guess that it had been in a while. I think there was 79,000 or 80,000 net short contracts
Uh-huh.
coming into Friday. So, that helped obviously, the short covering rally and, way, what was it up double the S&P, was it? I
Yeah.
think, yeah.
Yeah.
So that's definitely a big squeeze going on. And it's, I think in the last 3 months, it's even beat the S&P now with that Friday performance. So, I think that we, the way we looked at it, and we happen to have been correctly positioned for that. That worked out well for us. So, doesn't always work out well, but that one did. And, any dips on the Russell, maybe up to 1 to 2% in that range. I think we're buyers on the Russell, and for various reasons. But you've got I don't know, you've got that what's the phrase I'm looking for, and I'll think of it at some point, probably after I tell you I can't think of it. But you're the stepchild syndrome with the Russell. Sometimes it's not
Oh,
getting a whole lot of attention.
no, no. In fact, they say that the reason they don't like it is because 40% of it is losing money, and also that there's no more gems in there. Like you used to be able to find like a
Mhm.
an Apple computer in there, or some an Nvidia in there, or something like that. And they say in this day and age, if you even look like you have a good idea, you get taken out. So that they say there's not any huge gems in there, and then of course a lot of the index is losing money. That's the negative side. The positive side is these things are valued at very low levels, and that lower interest rates is like the canteen of water in the desert to these things, right?
Yeah, yeah, good point. And ultimately it's about money flow, right? So the money and the attention and the headlines are always on the top, well, like the Mag 7, basically. Although I think Friday, something like 83 or 85% of the S&P stocks were higher, as I
Mm.
recall. But
Yeah,
that's
that was a
sort of
stampede on Friday. That
unusual.
was a stampede on Friday. There's no doubt about that.
Right, right.
Yeah.
But yeah, I think that I think the technicals are shaping up. You've got a nice breakout in the last month on the Russell, and I would like to not I would not want to say, well, put it this way, I wouldn't want to be short the Russell right now.
No, not with 38% or 30% short interest, and they are going to drop
Right.
interest rates. That sounds like, and then of course it's not even at the 245 high, which I think if it, just like the stock market, this guy was talking about, people like on a V-shaped bottom, like we obviously see on your screen there. They always question the rally, and they were questioning the rally on S&P, and they were questioning it on the Nasdaq the whole way up. But once it takes out the former high, then all of a sudden everyone becomes a bull again, you know? So I would think if this thing ever takes 245, everyone will be going, well, of course you should have part of your portfolio in the Russell. You know what
Yeah. That was easy to see.
I mean? It's no, but I mean, it happened in 2019. It happened in
Yeah.
2020. I mean, it happens every time. You get these V-shaped bottoms that nobody believes in, even though they've happened like 12 times in the last how many years. And again, it's human psychology. They can't admit that they were wrong on getting out. And until it makes a new high and they have confirmation they were obviously wrong, then they start obviously coming back in a little bit more.
Well, then they start chasing it.
Yeah. Yeah. One big thing that's been talked about is the financials. So I was going to look at XLF, and Dan, I wanted to get your opinion. XLF and KRE. KRE is the regional bank, and XLF obviously are the big boys. And somebody was saying that with this, possibility of going stable coin and blockchain and moving money around. I mean, money markets could possibly turn into like stable coins. And so the banks may see a re-rating. And also, there's as much as $10 trillion that could be refied if we got mortgage rates down to a more normal level, because mortgage rates are supposed to be like 160 basis points above the 10-year. Oh, no, above the inflation rate, or is it 10-year? Probably, well, right
Mhm.
now, I guess it would be the 10-year. And so
Mhm.
the 10-year being around four, it should be like 560, 580. And, mortgage rates are like seven and a half, eight and a half, or whatever they are. You know what I mean?
Mhm.
So if those mortgage rates did get normalized, which is what people are kind of betting on now, these banks could be re-rated. Their PE ratios on the banks are pretty darn low. And so, I mean, do you guys have any feeling like there could be this huge opportunity in financials? I was going to start with Dan.
Um, Yeah, I mean, I think when interest rates change, it gets interesting for the banks. And this opportunity to have, I mean, not just refinancing, but right now I mean, it's hard for somebody who's, 28 years old to buy a house.
Yeah.
And a big part of that is just because of how much the interest rate makes up on that mortgage loan.
Hmm.
So if I mean it depends on how far rates go down here, but I mean if we start getting a little bit more aggressive cuts in the interest rates, we're going to be seeing, I mean that's going to be a boon I think for real estate in general and mortgages for sure. So yeah, I mean you do bring up an interesting point.
Yeah, because I mean, there you can just see from this chart, it looks like they're on their way someplace.
Mm-hmm. Mm-hmm.
And what about XLF? How does that look? Those are the big guys. This is the regional guys,
Mm-hmm.
and XLF doesn't look too bad, but not quite as jumpy as the other here. Oh, that's select XLF. Yeah, that's it. And not quite as robust, but maybe all of this little back and forth dancing is followed by a breakout, possibly. You don't know. Did you have an opinion on that, Eric, at all, or?
Yeah, it's not really a particular ticker that we follow, but generally speaking, I wonder too if lower, this could get, really almost not conspiratorial, but like you have the Trump administration now, and you've got him berating Powell,
Mhm.
too late Powell, and he's been suggesting in no uncertain terms that rates need to be a lot lower. And, meanwhile, the stock market's, soaring, or at least at or near all-time highs. But, you almost wonder if they're looking forward to a large correction, let's say, in the stock market, and then using that as sort of catalyst to point their fingers at Powell and the Fed, and
And to get
say,
the rates way down, which would
and to
generate a
get
lot of cash,
exactly.
which the cash could come back into the stock market.
Exactly.
Yeah.
So, it's in other words, they probably wouldn't mind if the stock market, generally speaking, pulled back quite a bit at this point in time. It might even work to their advantage, in the next 6 months or something. But, having said that too, I wonder too if you get the Fed lowering rates, and perhaps the 10 and the 30-year follow. I mean, heck, it doesn't always follow, right? Or at least immediately.
Yeah,
As
well,
we've
because like last time they've dropped it 50 points and the rates went up. So
The
that could
rates put it
easily,
up.
yeah, that's easily could happen again.
Right.
Mm-hmm.
So,
Right. I
yeah.
guess so. I don't know. I don't know what to make of that. But even if it did, even if the long end kind of followed somewhat, and now you've got mortgage rates down, and now homes are presumably more affordable. Um, I don't know, but doesn't maybe the price of the home just go higher? Because now
Well,
you
I
have
think
more.
every
Yeah.
time they drop the rates, that's what happens. Because people buy the house on their house payment. Oh, I can get $1 million house because it's only $1,200 a month.
Yeah.
You know,
Mm-hmm.
So I
uh,
don't I don't know how that resolves. I was going to watch a comment from this woman who follows the housing market, and I kind of have it queued. Melody Wright.
okay.
She's presumably well, I know who she is, and I don't know her, but she's very well read on this subject. But she's kind of suggesting that the housing market is going to have some hiccups here in the next 6 months.
Well,
So
how do you feel it's going in Orange County? Because obviously that is the kingpin of high priced real estate. Is there some volatility, or is there just a lot of inactivity? Right.
no, it's still active. I think what did they say? All real estate is local to some degree.
Yeah.
So, you know, it's still perhaps a desirable place. There's still employment. There's still, well-paying jobs in the area.
Yeah.
And, you've got the weather and the climate, and that brings people in as well from wherever. So, the market is still very, very expensive. But I mean, relative to what, I don't know. But
Yeah.
relative to 10 years ago. Yeah.
Because here in Nevada, it seems like the 750 grand to $1.5 million neighborhood is stagnant. And I've been around real estate enough to know, because I used to be over in Orange County, is that when you start hearing that like uh, dollar figure that requires, a decent amount of money getting a little bit stagnant, it sometimes means the lower stuff also is getting a little slower too.
I think that's the same case, the same thing in parts of Arizona, isn't it, as well?
Yeah, that's what I'm trying to say. So I
Yeah.
definitely think there's a real estate issue going on here. And then, at some
Idaho.
point, if they start cutting the prices, actually, maybe that probably has to happen. Maybe that's why they're keeping these rates so high, to kind of soften up some of these prices, because, the prices had jumped after COVID, probably 40% or 50% on some of these houses, right?
Yeah, absolutely. That was
So.
insane.
Well, I'm going to flip it over to a different subject, Dan. Do you follow the gold market at all? Because I would imagine some people are trying to figure out if it's going to 4,000 or 3,000. So why don't you help us figure out where it's going here?
Sure,
Not that
sure.
not that not that even it knows what it's doing, because Friday it looked like it was on its way up, and then today it looks like it's having some trouble.
Yeah, yeah. Friday was an interesting day with the market up so much and gold up so much.
Mm-hmm.
Um, and and part of this, I think, piggybacks off what we are just talking about. I think that as interest rates get cut, that helps fuel inflation. Um, at least in the short term. And there's an argument about whether that's persistent inflation or if it's with tariffs, with tariffs also, it's an argument as to whether it's persistent inflation or a one-time event. So there's that, which we could see in next quarter's earnings. But then interest rates being cut also can drive that. So I think that puts upward pressure on gold, which has already had some fundamental pressure with, at least for a while, the Chinese government just buying lots of it month after month, the Russians as well. We've kind of been in this range for, gosh, it's been a tight range for what is that, about 3 months or so?
Mm-hmm. Very tight, and also choppy on both sides of the moving average. So if you're kind of looking for a trend here, every time you bought and thought it was going to go up, they brought it down. Then you went short, then it went back up.
Yeah.
So chop suey. That's what it looks like, right?
Yeah. Uh, I'm a statistical thinker. So if the choice is it going to hit 300 or 400 next, I got to go 300 because we're right, we're close. But yeah, if the choice is 200 or 400, I would go 400. Um, and the way I think about gold, rightly or wrongly, I think it's rightly, otherwise I wouldn't think about it this way, is that it's not really the price of gold going up, it's the value of the dollar going down. And not just the dollar, but the value of all currencies versus arguably real value. And gosh, we could talk for hours and hours philosophically about that. Um, but that's the way that I think about it with fiat currencies in just about every country. It's really the value of currencies going down versus this thing that, though it's arbitrary, it's always sort of been the case for the global, international, historical means of exchange. So anyway, to answer your question, yeah,
Well, you still think there's an upward bias to it,
yeah.
although, yeah, obviously you can see it's in this little pennant here, and it's getting near the end. So I would imagine by the fourth quarter, we will have a very good idea of which way it wants to break. But yeah, you'd have to say the preponderance of the evidence is still that it is uptrending. But when it
Mhm.
does break, boy, will there be a lot of people to come out, because this thing's been going up since 2023 from
Mhm.
$1,700 to $3,500. And
Mhm.
like you say, the central banks have really loaded up. I was thinking they were loading up because they want to get something that might back a new currency, because maybe they're tired of, getting their assets frozen every time they don't do what the U.S. says. You know what I mean?
Mhm. Mhm.
But
Yeah.
do you, Eric? Do you have any feeling on the gold at all, or?
What Dan said
pretty much. Yeah, yeah, yeah. Well, that's it because again, it's in this little window, and the window does, as you can see from the blue line, have an upward bias. So obviously, you'd have to, and guys like Fidelity are looking for 4,000 gold next year. So you'd have to respect that. But I tell you one thing: if it broke under 3250 and these things started rolling over for whatever reason, and that RSI that's lagging the price quite a bit right now, if that started to go way underneath 50 and under 40, that would shock a lot of people because again, people are pretty darn bullish. It might just have a sharp pullback to 3,100 or something like that. You know what I mean? And then go on its merry way back up. So there could be a flush, I guess, possibly.
Yeah,
yeah.
Yeah, I mean, well said, of course. So, that's the best performing asset class for last 2 years.
Yeah.
I even think year to date, right?
Yeah.
So,
and the gold stocks are going nuts. I've got things like in Newmont Mining and the GDX. If you put that up there, GDX, people are definitely plowing in. They finally plowed into it. For a long time, this thing didn't do anything. Look at this thing. It was floating around $30 just in Q4 of 2024. Then obviously somebody lit a match. And ever since this year, they have gotten into the gold stocks because I guess they did the math that, 30 a sustained price at 3,500 area is pretty darn profitable for a lot of these gold miners.
Yeah, good point.
Yeah, but they really took off. There's a sneaky one I want to talk to you about, and that's crude oil. If you can put up the crude oil chart, because XLE was trying to make a little bit of a turn here. Now, like everyone obviously is talking about the glut that we're going to have, and everyone's talking about how oil prices are going to collapse. And what was Trump's thing? Pump? What is it? I forgot what it was. He had a little saying. Drill, baby, drill. That's the saying. Drill, baby, drill. Anyway, so drill, baby, drill. I don't know what's going on, but it seems like somebody's trying to. Now, obviously, you got a lot of resistance above here, but they're trying to make a turn. And if you put up XLE, which is primarily Exxon and Chevron, you could see that it also looks like it might be going up as well. I guess this is USO, which is also another. Yeah, XLE is in more. There you go. So I was finding this to be a little interesting, as if it's trying to break out. You got that little dotted line that's resistance. But if you started, and there's a gap up there as well, so there might be trying to go up and fill that. Do you guys have any gut feeling on the energy market? Is there a future there? Because a lot of those oil stocks are, pretty depressed. Occidental Petroleum trading around $40 and change. Dan?
Yeah, geez, I don't know, man. The crude oil market. I mean, there's just so much that goes on with it.
Yeah.
I I wish I could say something helpful here, but it's I mean, it's just not one of those things that I focus all that much on.
Well, it's out of favor. Obviously, you just look at the chart. It hasn't done a whole lot of anything. That's why people have thrown it out with the bathwater here. But it is something that we use quite a bit, and it is something that there's not a line wrapped around the block thinking it's a great place to have some of your money.
Yeah. I mean, yeah, it's been in this. I mean, I don't know. Markets hate uncertainty, and when something like crude just stays in this really, really super tight range for a couple of months here, and gets ready to break out, I don't know. I mean, I think once the breakout happens, it's probably something to jump onto.
Yeah, better to talk about this if we can get above 90 on that or above 70 on crude. All right, before we run out of time, let's talk about the 800-pound elephant in the room, which is Nvidia, NVDA. And of course, that is got big earnings coming out on Wednesday. It was up today. Some people are calling for about 210 on the price if they come out with good numbers. Do you guys have any feeling on Nvidia, starting with Erik?
Oh, I have a few small thoughts, but you guys might have a lot more to say on this. But I think and maybe Dan would know, and he could correct me if I'm wrong, but I read maybe Friday that options markets were pricing like a 1.4% move on Nvidia post, earnings. So the volatility wasn't expected to be too great according to the options market, but
Mm-hmm.
thought that was interesting because sometimes expectations can be for these dramatic moves.
Mm.
But I think that you again, I wouldn't want to be short Nvidia if that kind of says it.
Yeah,
I
and the
think that
put
kind
and
of
the
says it
put the
all.
puts that expire. Yeah, you make a good point. The puts that expired Friday, I see the out of the money puts are down like 30, almost 40%. But the calls are only up 9 or 10. So
Mm.
it's not exactly everyone is crazy bullish, but they are, like Erik said, they're not interested in hoping it goes down.
Yeah, I think the top
Mm,
some of the stuff we read and follow in the research we look at, they're suggesting a range of 174 to 187, and that was earlier this morning. Basically the high and the low range of
mhm.
expectations. But of course, that's a moving target day by day, and could look a lot different by Wednesday. But yeah, I would say the sentiment, the money flows, the institutional ownership, the technicals, you name it, all the above. The I guess you could say the headline buzz, the narrative, whatever. It's it's a tough thing to want to be, get cute and try to pick a top here and go short. So that leaves you either with out of the market or maybe cautiously bullish and trying to buy dips.
Mhm. Dan, you got a feeling on this thing?
Yeah, I mean, like a couple of thoughts. One is, I mean, it's got a 58 P ratio, 52 price to book ratio. I mean, these are elevated numbers. I mean, they make the assumption that this company's earnings are going to continue growing either a lot and or for a long time. Um, and then, interestingly, we had the Trump administration investing in Intel, which I think they made it official over the weekend, if I'm not
Yeah, yep,
mistaken.
yep. 9.9% stake. And that would just make me think that there's a legal consequence if you hit 10%.
Oh yeah, yeah. Uh-huh.
And Donald Trump would know all about legal consequences of everything you do in life.
Indeed.
The king of
Um,
the tort.
yeah, so and apparently there's no voting rights, but I mean,
Hmm.
who cares?
Yeah, right.
Right? I mean, they can be influential. Uh, Anybody in power like that owning 10%, especially Trump, though. So, I mean, it just makes me wonder if this sort of, I don't know, do people say nationalization? I don't know. I don't think we're supposed to think about it that way, but um, I think this government owning 10% of it, it's pretty interesting because maybe that means a lot more projects, a lot more government chips being bought from Intel rather than their competitors, one of which is Nvidia. Um, I don't know, but also, I mean, as far as earnings goes, right now the straddle on the close here today was priced at 6.7%. So you'd need a 6.7% move just to break even. The previous gap moves, like from the close to the open, over the past couple of years, they've been mostly under that. I mean, last time the gap was 5.4%. Um, in May of 2024 is 7.4. Quarter before that is 11.2%. But volatility has been actually getting a little bit bigger on earnings announcements, just kind of increasing over the past maybe 3 quarters. So I don't know. I mean, I sure wouldn't want to be buying straddles going into Nvidia's earnings. I wouldn't be selling them either, but
Yeah,
I
it
don't know.
doesn't look like a good setup. I will say one thing though, the RSI having come down to 50 would tell you that a lot of the selling, has come out a bit, and
Mm.
the RSI turning back up here. There seems like there's a lot of real estate between where it's trading and the top of the range. So, if it did
Mhm.
want to get a $20 move up because they announced a big surprise in either their margins or in their revenues, the room on the RSI is there for a pop like that.
Mhm.
And like I
Mhm.
say, it is quiet going in, relatively speaking. Normally didn't it used to be like 10 or 15% discounting volatility? I remember one time they were discounting a $40 move up or a $40 move down. And that told me obviously. And then it came out and it only moved $3. All I could think of is Eric. Guys like Eric are happy. Those premiums must be collapsing as we speak.
Every
Anyway,
now and then we get a good one.
yeah, exactly, exactly. Anyway, so yeah, let's start talking a little bit about what you guys do and how people could get a hold of you and that kind of stuff. Eric, start out by explaining all the ways you help people.
Yeah, sure. We we are a introducing brokerage firm for futures and options. So that's our core business is brokerage activity, but we also created our own software application a few years back called Theta Trader. And what that does, it will automatically create and build the spread trade for you. And then you can then submit that order. You can use a trade alert response to submit the order. So we'll send a trade alert to you. You'll receive it on your device, like your smartphone, and you just touch accept. And once you touch accept, then we'll process the order. And if the order's filled, then Theta Trader will track that position, and then it can automatically close out the position for you if you'd like it to, whether it hits a risk target or a profit target first, whichever comes first. So we do a lot of premium collection, but that's not all we do. So there's plenty of debit spreads and butterfly strategies and other things too, or even just simple outright vertical debit spreads and even outright calls and puts sometimes that we buy. But primarily, we like to stick with what we think are the higher probability outcomes, which would be selling options and collecting the premium on the stock indexes and primarily the E-mini markets. And that's where the volume is, that's where the depth and liquidity is. And we think we get better execution compared to just about any other market available. And there's some tax advantages, of course, when trading in futures as well. You get the tax efficiency, or your gains are taxed 60% of those gains at the capital gains rate. So there's some tax advantages as well. But that's what we do. So if you'd like to set up a demo account, you can just visit our website at altavest.com and get a free demo account. And feel free to reach out to me anytime at Erik, ERIK, at altavest.com.
Yeah, and you can what do you call it? And you can set up a demo account to try out some of the strategies and get comfortable with the
Right.
technology, right?
Right. Absolutely. Demo account works just like the real thing, except it's fake money.
Yeah, well, while you learn, it's not a bad thing. And
Right.
this I think this one-touch trade alerts where you can get the alert and then put the trade in on your phone kind of thing. Is that it?
Yeah. In fact, it's even more simple than that. The alert is sent to you, and you'll see the alert kind of on your screen, and you'll see a description of the trade, a graph of the trade, and the profit and loss potential and the capital required. And then if you want to take the trade, you just touch accept. And then that's it. Our technology processes everything. And then if the order is filled, then Theta Trader will then manage it for you and close out that position when it hits a risk or a profit target,
Gotcha. And as far
whichever
as the
comes. So yeah,
requirements,
clients love the
yeah.
convenience for sure of the trade alerts, and they don't have to log into some other platform or try to a trade and mess up the transcription. I've had people place orders elsewhere and saying they have an alert service, which is fine, but then they'll do a buy sell error or something like that when they
Yeah,
place the orders.
yeah.
Anyway, yeah.
And what do you call it? Yeah. So this is, and a big part of people's problems nowadays is time. And so, to have this stuff delivered to your handheld device is really convenient for most people because, again, it's hard to follow this stuff while you're trying to drive around town or picking up kids or doing your job or whatever. So this is I would imagine this to be a very popular thing, huh?
Yeah, it is.
Yeah.
It is. That's the response we get is basically what you said. I'm living my life, and I don't have time to screen watch. And there are people who do that, and they can make it work, but most people don't have
Yeah.
time to really sit in front of the screen.
Yeah. Well, Dan, do you want to spend some time here and let us know about how you're helping people?
Yeah, sure. That sounds great. So I am with Market Taker Mentoring, and we help option traders to reach their goals. We do that through one-on-one coaching. If you go to our website, which is just markettaker.com, two T's in a row, market like stock market taker, like take what is rightfully yours, markettaker.com. And just go up to I don't know if you can see my screen, but just go up to the top right-hand corner. You can click apply for one-on-one coaching and talk to somebody from our trader success team. No pressure, just, talk about the things that you're struggling with and see if there's a good fit there. And you can also join and get some free classes as well. And we've been doing it for 17 years. We've helped tens of thousands of option traders finally make it after years of struggling sometimes.
Yeah, it's nice to get some input. Everyone always talks to me about the learning curve. One guy was telling me today, he's over at Interactive Brokers, and Interactive Brokers, is a great company if you like their technology, but they're not really known for hand holding, I don't think, or
Mm.
really walking you through stuff. So the gentleman was complaining that the learning curve over there was tough for him, and so that's why there is a big audience for people who a little bit of a little bit of input could help them get through a lot of the basic questions and things like that.
Mm-hmm, mm-hmm.
So, well, both of you guys definitely have a lot of stuff to offer to everybody. So I hope, obviously, not only the live audience we have here, but those who watch it on tape, get a hold of you guys and find out how you can help them. You both have distinct ways of helping people do their trading, and so I think both of you guys bring a lot to the table. So that's great. I am going to be having a webinar tomorrow for those people that are interested in a webinar on the options. You could email me at optionprofessor@gmail.com, and then you can get the link. So if you're interested, that's how you do that. And yeah, so anyway, the more you know, the better off you are. And you had two opportunities here with Dan and Erik to really get some good stuff. So please take advantage of that and do your inquiry so you can find out how they can help you. Thanks a lot, Dan and Erik, for being here. I think we went over a lot of stuff here today that are helpful, and hopefully everyone will get a hold of you so you can take it from there. I'm going to bring it over to David now, and then I am going to remain for the meeting that I'm going to have afterwards.
All
Thanks,
right.
everyone.
Thanks, Erik. Thanks, Dan.
Bye.
All right. Yeah. Thanks, guys, for being here for this special 11th anniversary episode of the Crowd Forecast News. And also, so just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube, Substack, or your favorite podcast app. Or if you just go to TimingResearch.com, this post right here will become the archive as soon as I can get it processed this evening. So I just want to thank my panel again for today. Dan Passarelli of MarketTaker.com, Erik Gebhard of AltaVest.com, and the Option Professor of OptionProfessor.com. Thanks, everyone.